Every year, you hand over a chunk of your paycheck to the government. You do it because you have to. But here's a question that most people never stop to ask. Are you paying more than you actually should be? The answer, for most working Americans, is yes. And the reasons why go far deeper than just picking the wrong tax bracket or forgetting to claim a deduction. The real reason you pay too much in taxes has to do with how the tax code was written, who wrote it, and who it was actually designed to benefit. In this video, we're going to pull back the curtain on the American tax system. We'll look at how it actually works, why the wealthiest individuals and corporations pay far less than you might expect, and what the average person can do to legally keep more of their own money. This is not about cheating the system. This is about understanding it. Let's start with the basics. The United States uses a progressive tax system. That means the more you earn, the higher percentage you pay, at least in theory. In 2024, tax brackets range from 10% at the lowest end all the way up to 37% for income above $590,000 for single filers. But here's where most people get confused. You don't pay that top rate on all of your income. You only pay it on the portion of income that falls within that bracket. So if you're in the 22% bracket, that doesn't mean you're handing over 22 cents of every dollar you earn. It means you pay that rate only on the income above the lower threshold. This is called the marginal tax rate, and not understanding it costs people a lot of mental stress and sometimes real money, because people make decisions like turning down a raise or avoiding extra income based on a fear of jumping into a higher bracket. But moving into a higher bracket only affects the dollars within that bracket, not all your earnings. Now, on top of federal income tax, most Americans also pay Social Security and Medicare taxes, collectively known as FICA. These come to about 7.65% of your wages, and your employer matches that amount. Self-employed individuals pay both sides, roughly 15%, because they are both the employee and the employer. And then there are state income taxes, property taxes, sales taxes, and more. Add it all up, and many middle-class Americans are effectively paying 30 to 40% of their earnings in various forms of taxation. That's a significant portion of your income. And yet, some of the wealthiest people in the world are paying effective tax rates that are dramatically lower. How is that possible? The answer lies in the difference between earned income and investment income. When you go to work and get a paycheck, that money is classified as ordinary income. It's subject to the full range of federal income tax rates. But when a wealthy investor sells stock that has gone up in value or receives dividends from a company they own, that money is taxed at the capital gains rate. Long-term capital gains, that is, profits from investments held for more than 1 year, are taxed at 0, 15, or 20% depending on your income level. For most high earners, that's 15 to 20%. Compare that to the 37% top rate on ordinary income, and you start to see the gap. Warren Buffett, one of the wealthiest people in the world, famously pointed out that he pays a lower effective tax rate than his secretary. His income comes almost entirely from investments. Her income comes from a salary. The system taxes them very differently. This isn't an accident. The capital gains tax rate was specifically set lower with the argument that it encourages investment and economic growth. Whether or not that argument holds up is a matter of debate. But the effect is clear. People who earn money by owning things are taxed less than people who earn money by doing things. And it goes further than that. There's a provision in the tax code known as carried interest. Hedge fund managers and private equity executives often receive a portion of the fund's profits as compensation. Under normal logic, this would be taxed as ordinary income, since it's compensation for their work. But thanks to a tax rule, this compensation is treated as capital gains instead, meaning it's taxed at the lower capital gains rate. This loophole has been debated and criticized for decades by lawmakers on both sides of the aisle. Attempts to close it have repeatedly failed, in large part because the financial industry spends enormous amounts of money lobbying to keep it in place. Which brings us to the next piece of the puzzle: corporations. The corporate tax rate in the United States was cut from 35% to 21% in 2017 under the Tax Cuts and Jobs Act. But many large corporations pay far less than that, and some pay nothing at all. How? Through a combination of legal deductions, tax credits, depreciation rules, and offshore strategies. Large companies can deduct enormous expenses, research and development costs, executive compensation, interest payments on debt. These deductions reduce their taxable income significantly. Some companies take advantage of depreciation rules that allow them to write off the cost of equipment and infrastructure quickly, even if those assets are still generating value for years. And then there's the offshore strategy. Companies like Apple, Google, and Amazon have legally structured parts of their businesses in low-tax jurisdictions, places like Ireland, the Cayman Islands, or Luxembourg. By routing profits through these subsidiaries, they reduce the taxes they owe to the U.S. government. The scale of this is staggering. Estimates suggest that U.S. corporations hold more than $2 trillion in profits offshore, shielding it from domestic taxation. Now, these strategies are legal. The companies are following the rules as written. But that raises a bigger question. Who wrote the rules? The U.S. tax code is more than 74,000 pages long. It is extraordinarily complex, and that complexity didn't happen by accident. Every deduction, every credit, every exemption in the tax code was put there by Congress. And Congress is heavily influenced by lobbyists who represent corporations, industry groups, and wealthy individuals. The financial industry, the real estate industry, the oil and gas industry, these sectors have spent hundreds of millions of dollars over the years advocating for specific provisions in the tax code that benefit them directly. Real estate developers, for example, benefit enormously from a provision called depreciation. Even if a building is increasing in value, the tax code allows owners to deduct a portion of its value each year as if it were deteriorating. This creates paper losses that offset real income, meaning wealthy real estate investors can sometimes show a loss on their taxes while actually building wealth. Combine this with the mortgage interest deduction, the 1031 exchange rule, which allows investors to defer capital gains taxes indefinitely by rolling proceeds from one property sale into another, and it becomes clear why so many of the ultra-wealthy are involved in real estate. So what does all of this mean for you? Here's the truth. The average working person doesn't have access to offshore tax shelters or armies of accountants. But there are legitimate, legal strategies that can reduce your tax burden significantly, and most people aren't using them. The first is maximizing retirement contributions. Contributions to a traditional 401k or IRA reduce your taxable income dollar for dollar. In 2024, you can contribute up to $23,000 to a 401k or up to $7,000 to an IRA. If your employer offers a match, that's essentially free money, and the tax savings are real. The second is the Health Savings Account, or HSA. If you have a high-deductible health plan, you can contribute pre-tax money to an HSA, invest it, let it grow tax-free, and withdraw it tax-free for medical expenses. It's one of the only triple tax-advantaged accounts available to ordinary Americans. The third is understanding the home office deduction. If you're self-employed or run a side business and you use part of your home exclusively for work, you may be able to deduct a portion of your rent or mortgage, utilities, and internet costs. Many people either don't know about this or are afraid to claim it, but it's a legitimate deduction that can add up to thousands of dollars. The fourth is tax loss harvesting. If you have investments that have decreased in value, you can sell them at a loss and use that loss to offset gains elsewhere in your portfolio, reducing your capital gains tax. You can then reinvest the money in similar assets to maintain your investment strategy. And the fifth is simply working with a qualified tax professional. The U.S. tax code is built to be navigated by people with expertise. A good accountant or tax advisor who understands your specific situation can often find strategies that save you far more than their fee. None of these are secrets. They're all in the tax code, but most people either don't know about them or don't take the time to understand them. And that's exactly how the system stays the way it is. Because here's the uncomfortable truth about taxes. Complexity favors those with resources. The more money you have, the more you can spend on advisors and accountants who understand the code inside and out. The more influence you have, the more you can shape the code itself. The average working person just files their W-2, takes the standard deduction, and hopes for the best. And in doing so, they often leave money on the table. Money that could be saved, invested, or used to build a more secure financial future. Understanding the tax system is not just an accounting matter, it's a matter of financial literacy. And financial literacy is one of the most powerful tools available to ordinary people trying to build wealth in a system that wasn't necessarily designed with them in mind. So the next time tax season rolls around, don't just reach for the simplest filing option. Ask questions. Look at the deductions you might be missing. Consider speaking with a professional. Think about how you're structuring your income and investments. The rules are complex, yes, but they're the same rules everyone has to play by. The difference is that some people understand the game and some people are still learning it. Now you know a little more. If you found this video useful, consider sharing it with someone who needs to hear it. And if you want to dive deeper into personal finance, investing, and building wealth, subscribe to this channel. We cover these topics in detail because understanding money is the first step to having more of it. Thanks for watching. We'll see you in the next one.